Hey everybody, thanks for joining us today. And I am here with Tracy with the Benjamin Group at CrossCountry Mortgage out of Salem. And we've worked together for quite a few years. And as we look at 2026 and the changes and everything, I just wanted to connect with Tracy and record this conversation and put it out there for you guys as you make your plans towards buying and selling real estate this year. So, thanks for taking some time, Tracy. And the Feds met today, and
Good to
to
see you, Tim.
tell us what they decided.
Okay, so here their favorite measure of inflation is PCE.
Okay.
Okay, it was 2.8. So
Okay.
they want it to be down around 2%, right? That's their magic number. They decided since it was at 2.8 that they would not change rates today. However, there are some better measures of inflation that they
Okay.
don't use, like the consumer price index. That's a good
Okay.
measure. And that was sitting at 1.9.
Okay.
So we're below the target.
Gotcha.
We're seeing manufacturing slowing. We're seeing more layoffs.
Yeah.
Those that are being laid off are taking longer to get back into the workforce. So they're
Right.
receiving unemployment benefits longer than
Mhm.
what was, this time last year. So they have to recognize that. The prediction is that we're going to see rate drops. Maybe not at this, that obviously not
Right.
today. I still think that, and it's a lot of other industry professionals are thinking we're going to see four times rate drops this year.
Amazon just laid off however many,
I
other
think that was
thousand
16,000
people.
people. Yeah,
Yeah.
and they're not the only ones laying off. Just give it a moment. And then
Right.
we're going to also see a shift in the Federal Reserve. So right
Right.
now they've been hawkish. And what hawkish means is that they are so concerned about inflation. We
Right.
got to curb inflation. That's what a hawkish stance is.
Okay.
We're going to flip to a dovish position
Okay.
because who is going to be appointed as the new Fed
Fed chair. Yeah.
chair, thank you, the Fed chair is dovish.
Yeah.
I think there's three or four candidates, and they're all dovish.
Yeah.
That means that they're about growth.
Right.
They're about growth to be able to curb inflation.
Yeah. And that's what May.
Yes, we're going to see the flip where they're going to
Yeah.
be more concerned about growing. The economics of of the country to
Yeah.
flip to growth. It's going to shift the mindset.
Right.
Then we're going to see a lot of different changes in how the Federal Reserve approaches keeping activity
Gotcha.
going in the marketplace and
Okay.
the economy going.
All right. And then give us the, layman's understanding of the relationship between the Fed's overnight lending rate and mortgage interest rates
Good
for
question.
people that don't understand.
So many people say, "Oh, the Feds are changing the rate, changing the
Right.
rate." Well, it is not. It's just an indicator for us. That is not what long-term mortgage rates are tied to.
Okay.
What's tied to the Fed funds rate is short-term loans, like your auto loans, your
Okay.
that type of consumer loan, your home equity lines of credit,
Okay.
second mortgages. Those are tied specifically to the Fed funds rate. That is the rate that banks buy money.
Right.
Okay.
Yeah.
And so though it's a market indicator, it's not what we are tied to. Bond market. We are
Okay.
tied to the bond market. What
Gotcha.
the 10-year treasury is doing is what affects us.
Okay.
So if you see, like, we want to see that the 10-year treasury gets below 4. Like, we
Okay.
hit below 4 in rates, we got a little refi boom. Like,
Yeah.
you're seeing little bursts of rate drops.
Right.
Okay. Then it flickers back up again, and then it
Yeah.
comes back down gradually.
Where are we at now? Did I see like 4.5 or 4.75?
The treasury right now is at 2.5 is what we ended the day
Okay.
with.
Okay.
But we've gotten below 4.
Yeah.
Okay?
Okay.
That's why we're up. We're gradually coming back down. We're
Yeah.
probably going to see the 10-year treasury sometime this year, probably around 3.8
Okay.
is kind of the projection. We're going to see rates. So everybody wants to know, well, what are rates going to be? What are rates going to be, right? So rates are projected to be right around 5.7.
Okay.
Maybe we'll hit 5.5,
Uh-huh.
sometime this year.
Right.
Do I know when that's going to happen? No, I
Yeah.
don't.
Right.
But what I tell people now is, for your buyers,
Uh-huh.
we're going to see a market surge in where right now we have a supply.
Yeah.
We have people making deals, sellers
Right.
doing concessions. The market is a little soft. Well, once we hit down below 6 and 5.7, all the inventory that we have right now is going to get eaten up and it's going to turn into a seller's market.
Right. Yeah.
So because here's the thing, as demand gets eaten up, then there's not going to be enough houses for what people want to
Yeah.
to into the market. There's just not
Right.
going to
Yeah. Right. And then prices are going to start really going up
start
again.
skyrocketing. So those people that are on the fence now get off the fence and
Yes.
get into the market, because
Absolutely.
now is your sweet spot where you can buy something, get seller concessions, get in, even though the
Yeah.
rate's higher, you can always refinance here this year. You'll be
Yeah.
able to gain that back, but at least you're already in the home and you're not spending $20,000 to $50,000 more for that house. In order for first-time home buyers to come in the market, we have to get the people that have been sitting in their homes at a 3.5% interest rate
Yeah.
to buy the house that their
Right.
dream, right?
Yeah.
Well, it makes sense at 7.5% or 7%,
Yeah.
did it?
Right. No.
There was too much of a spread between their payment and the new interest rate. And they're sitting on a ton of equity. We
Right.
have more equity in our houses now than we've had in years.
Yeah.
So those people that bought 2019, 2020, they can now use that equity to go buy the bigger home,
Yeah.
put money down, even though it's a little bit higher interest rate. They have a smaller loan and they can take some of that money, from the proceeds of sale of their house and use it to buy down their interest rate permanently.
Oh, there you
So
go.
then now there's only maybe $200 or $300 difference in their mortgage payment than they had before when they were sitting at 3.5. But
Yeah.
now this home that they're in is better neighborhood, maybe bigger
Right. Yeah.
home for the accommodating of their families.
Right.
Those kinds of things that go into making decisions to move.
Right.
So that gap then is tolerable. This is the time before the market starts coming back up again.
Absolutely. And I think there's a lot of pent up demand. A lot of people were on the fence last year or sat out um, for various reasons. And boy, turn the corner here into January and rates touching 6%. Boy, my phone started ringing. People were coming out of the woodwork. So I already know it's warming up, even though it's January, or January is almost over. And so yeah, I think we're going to have a pretty fast-paced spring market.
Yeah, I think it'll come early. We're going to see those people that are in their homes that came and bought in the last 3 years that were sitting in the sevens. Now is the time for them to refi. We are sitting at about 3/4 of a point lower than we were this time last year.
Last year,
So
okay.
we're already seeing the trend down. People are refinancing now.
Yeah.
What I'm seeing is that take the savings. Take the savings now.
Yeah.
Don't anticipate what the market's doing. You can save money now if it's a few $100s a month now for a refi, and then refi later. Like what I do for my clients is I always offer them a free no cost lender refi, in this environment, because I'm here just like you are. I'm here to help lead and guide and protect my own clients that I've done,
Yeah.
that I've helped, right?
Right.
So offering them very, no cost on their refinance helps them to, then it makes sense also too, that when we're back down lower again, that they can refinance again and still, and save even more.
I'm saying kind of the same thing to my folks is like, if you can buy now, which a lot of homes have been sitting on the market for quite some time, and maybe you can get them for say 10,000 or so under asking price, and you can get some repairs done as well.
The buyer is conscious about their payment, right?
Yeah, right.
You're gonna save more money using that money for the seller contributions towards buying down their interest rate
Oh
than
yeah,
you would by lowering the price of the house ten
yeah,
or
absolutely. Yeah,
$1,000.
yeah.
There's more
That's
money.
cash out of your pocket. Yeah,
Yeah,
exactly.
there
Or
is,
cash in your pocket.
right, there is more money saved in the interest rate than the house purchase price.
Well, thank you so much. I really enjoyed it today. And yeah, I think we're going to have a great year this year. And yeah, I'm with you. I'm just talking to my clients as much as I can to help get them off the fence and help them
Yeah,
get
this
in
is
the game.
definitely gonna be a strategy year and we're gonna start seeing, I think it's probably gonna happen, the lower rates will come to the back half of the year.
Right now is when there's the inventory where you actually have some things to
Yeah,
choose from.
and then you're not having to deal with multiple offers for
Right.
people
Yeah.
and having to get, outbidded or what,
Yeah.
that was a zoo last time we went through that and that's on the horizon again.
It feels like we have some inventory, but we're really at like 3 to 4 months, which is barely into a balanced market.
Right.
And that's going to go away real fast. And we're going to be back into a seller's market, and you're going to be competing against at least one other offer.
That's the thing is that we'll all wait for it to turn and catch the market. You're never catching the market. Do it now
Yeah,
and get in, and then we can look to restructure the loan when it makes sense to do that. Because then
exactly.
you're going to pay less overall. The cost of that house is going to be way lower than is if doing it
Yeah,
now versus having to get into a bidding war later. It's exciting what 2026 is going to come, but we're coming out of that downturn that we've had the last 3 years.
yeah, yeah. So I'm excited. Thank you, and we'll talk to you soon.
Sounds good.